but we do have kind of a standing agenda where we just give a quick status report, but it really does come down to perhaps an educational topic. I'm going to actually share a couple of slides tonight and talk about you know, high opportunity type potentials, but it does come down to selling motions and buying motions. And even if you are here for the first time, when we go to a poll, when a motion is made and a motion is brought to the floor, you are welcome and invited to vote yes or no on any motion that happens to be developed as we go here tonight. So let's go and get started with the financial status. We do have a Vivio accounting system. The unit value for the club is 2172. It's up slightly over last month, but we are a little bit troubled because this club has outperformed the market by 4 to 5%, going all the way back to the late 1990s, and the return since the first part of January 2010 is actually now at -8, and that's thanks to a couple holdings which have not done too well for us. But that -8% is based on a 10.3% internal rate of return versus 18.3 for the total stock market index, the Wilshire 5000. So you can see that -8 is right there. We have a little bit of cash on hand to start the meeting, about 9% of assets, about $22,500 in the portfolio. And no, in case you're wondering, they're not real dollars in this case. We actually distribute hypothetical dollars to everybody who comes and shows up, and in fact, I can actually pull up one of the reports. There's the benchmark report, which shows the 10.6 and the 18.6. I did want to show the member report to show how we basically keep track. And all I do is I just use the reports from the Citrix Online to enter basically some random amounts, demonstrating that you don't have to put money in every month, and the variable amounts, we use the variable accounting structure. That means that not everybody has to put in the same amounts. So you can see that some people are fairly regular attendees, Phil and Mary, every month this year so far, and everybody that is here tonight that has been in attendance for a few months running will actually receive, you know, $50, $60, $70, depending on your interest level in the session tracking tonight. So that's basically where that comes from, and we'll go ahead and take a look at the dashboard here in a second. But the main three parameters are right there: 13.0% annualized return for the par. Quality is quite strong. It's a very high, very excellent quality portfolio, and our growth is actually pretty high. We could stand actually a few more larger companies in the portfolio, and we'll take a closer look at that now. We do actually keep a public copy of the portfolio on the website, so you can actually retrieve this from the Manifest Investing homepage. I'm going to go to the actual dashboard here tonight. Not sure why it's running a little bit slowly. Maybe the raccoons are chewing on my wires. But here you'll get some idea of the basic status of the club. Again, when you pull up a default view at Manifest for a dashboard, and again, this is if you're new to dashboards, it's just a collection of the characteristics that we feel are most important: the projected return, the quality, the growth, and then a few ancillary type characteristics for the stocks that we like to follow. It's listed from top to bottom, the largest holding being Apple at this time. Apple accounts for a little over 9% of our portfolio, all the way down to advanced battery technology, which has taken quite a hit, actually. I believe we bought that at approximately $4, maybe closer to $5 a share, so it's taken quite a hit, and is now down to 1.6% of the total portfolio. So again, ranging from top to bottom. Go ahead, Ken.
Mark, we do have a question or a concern from Phil Wrench. He'd like us to discuss ABAT this evening. There's such conflicting information out there about whether this is an actual company or not, and he'd like to put that on the floor for discussion.
Okay, we can't avoid discussing that one. we were kicking it around this morning a little bit, and in fact talked about how back in January we actually made the comment. In fact, it might have been you, Ken, that said we had a small position in ABAT at the time. We should either sell it or make a decision to accumulate more. And I think that's the type of position that we find ourselves in now. You know, it's kind of a sketchy situation, but it's also a fairly high potential return situation. So we probably should have that debate. Good point. And any other questions or comments on the portfolio?
No, things look pretty clear right now.
Okay, and here
Susan,
I'm going to go ahead and...
Oh, Mark, Susan Macholik wants to talk about hogs, too.
Okay. You know, we'll find out what she's got in mind there. It's probably going to be a little bit different than what I'm about to present. So we want to kind of air this situation out. What I've done now is I've clicked on the column header for the projected annual return. And what that does is it ranks from top to bottom, from highest projected return, and you see the two stocks we just mentioned as the highest projected returns, and Cisco, all the way down to returns that are actually forecasted returns, which are actually fairly close to the overall market returns, which right now is somewhere in that 7.5% range. So these are all excellent quality companies that happen to be basically fully valued or market valued at this time. So we do want to kind of turn our attention a little bit to the ones up here at the top. I don't see anything at the bottom here that's just a screaming, a raging cell type analysis or anything. So what I'd like to do is spend just a couple of minutes talking about kind of a high return environment. And what I'm going to do is talk about a little bit of a story. And I had advanced battery technology in mind as I was forming some of these thoughts. It's not exactly the same situation as the one you're about to see, but it's at least in the same type of ballpark. And it's not a core situation, so that's gonna make some people uncomfortable here, but I do think it's worth talking about. And what I would like to share is a couple of slides that Ken and I will be covering during our session up in Minneapolis in a couple of weekends from now. The weekend after Easter, Ken Kabula and I will be presenting pretty much the bulk of a program in Minneapolis at a regional conference. And this happens to be one of the slides that a couple of the slides that we're going to be presenting as some examples of what we're referring to as opportunistic investing. And this happens to be Select Comfort. For those of you that are not familiar with the company, this is the company that does the Sleep Number beds. And it's been a highly regarded company for many years going into the Great Recession, which is the area that you see here in gray. And they really took a horrible hit on price. They basically went from $28.52 that you can see here back in 2006, and during the Great Recession they actually dove all the way down to 19 cents. And we actually featured it as a Solomon Select monthly stock study opportunity at Manifest back in early 2007. So I was kind of stung by that at the time. A little while back, I'm sure some of you, like me, get a number of promotional email blurbs from the Motley Fool, and this is one of the Motley Fool's favorite stocks going back into that time frame. In fact, where you see this green arrow, that was following a point in time where the Hidden Gems newsletter for the Motley Fools had actually selected Select Comfort for the 4th time. It's the most times that they'd ever selected anything. Well, a few weeks ago, I got a newsletter, or a promotional newsletter from these guys, basically making the spiel or the pitch that they had a can't-miss opportunity in the world of investing. And if you actually sat through the whole opportunity, what it boiled down to, or the whole promotion, I should say, what it boiled down to is if you have a stock that's been multiple times recommended by the Motley Fools in the variety of their newsletters or whatever, it basically becomes something of a sure thing. And I'm looking at this and I'm thinking, you know, going from $28 to 19 cents, that doesn't exactly qualify. And right at the same time, I got a letter. In fact, I had received correspondence from one of our subscribers back in the early days of 2009, and he was basically suggesting to me that perhaps I was allowing my emotions to kind of cloud the situation. Of course, anytime you go from $28 to 20 cents, your emotions are going to be pretty strongly involved. But he basically was saying, Mark, you're probably not looking at this as well as you ought to. First of all, their financial strength rating is pretty good. I put the pendulum graphic there just as a reminder to all of us that we know that this happens in the stock market, that the pendulum swings both ways, too far one way and then back too far the other way. And he basically referred to this as a mother lode moment. And you know, the whole context of his argument was, do you really think the last mattress has been sold? And he actually followed that up with, yeah, they're going to have trouble. I mean, the housing market thing, the Great Recession, all that stuff has really thrown these guys for a loop. But we've known it's been a fairly well-managed company. I mean, you could go out there, you could reach and find all kinds of information that talked about the drifting away of a key marketing person, and you know, all kinds of stuff if you were looking for reasons to avoid it. But he pointed out that the company, again, back in this time frame, it had no long-term debt. So even as it went down into low single digits, and you know, had the delisting dance and all that stuff of possibly having to do a reverse split and all that, when a company has no long-term debt, it's really tough for it to go bankrupt, and there's no other way to say it. And you know, and his point was, if you really believed that this company was well managed and that ultimately their field of opportunity would clear, it was possible to believe that this red trend line, and again, this longer-term red trend line, you could go back a few years, tack on a few more years to the left, and you could have brought yourself to believe that this company probably was going to have some mode of recovery. Just knowing the company, knowing the management, knowing the product, knowing the market, and the simple fact that they had no long-term debt, etc. And there you see the bottom line, $1,000 invested in Select Comfort back around Christmas time, 2008. Again, that was in the absolute teeth of the bear market of the Great Recession, is actually up nearly 65 times. $1,000 has become $64,895, and it's the kind of point that I think does merit a little bit of attention, or at least some head scratching for us as we think about companies like Advanced Battery Technologies in this case, and it's such a small part of our portfolio. And let me just kind of reinforce that with a couple other things, and we can open up the floor for questions. I also wanted to show, well, first of all, let me tell one other quick story. I had been a part of an investment club a few years ago that had OMG in it. It happened to be that Mutual Club of Detroit, and we were actually having a meeting back in mid-2003. This company deals a lot in cobalt and a couple other special metals, and I think you can see that the stock price in this case, let me see if I can bump that up just a little bit. The stock price back in the 2003 time frame, actually late 2002, it was actually autumn of 2002, had gone from 73 down to 4. So again, I kind of feel like I've been here before. I'll never forget, we were talking about, we had, I think, a few thousand shares of this company, and we're sitting there talking about dumping it somewhere close to that $4 range, and I talked the club out of it, and just kind of basically that same argument of this has been a pretty good company. The challenges that they were facing at the time with a fairly strategic shortage in these very strategic metals was going to pass. And lo and behold, a few months later, the company had gone. In fact, I think we actually may have bought some at that time. The company went from $4 and recovered in a little over a year up to, you can see here, 26.8. So again, that's up almost 7 times or 700% over the span of just 1 year. And it actually felt kind of good to have actually, you know, been kind of personally responsible for a few $100,000 of avoiding lost opportunity in that case. So it's just something I kind of look back at as a lesson. It can be a pretty hard lesson. It can be a really tough lesson with respect to emotions. One last possible area of discussion before we get going tonight, on the Manifest Forum, I had actually posted, you know, all the stuff that you see here is posted on the Manifest Forum under the Challenge Club. I actually went and grabbed what I refer to as a deep value screen. I just want to share that with the group here tonight. This is from the Value Line resource. And what I did is I went out tonight. I said, why don't you show me a list of relatively high projected annualized total returns and I think these numbers in the high 20s and 30s qualify for that. I said I would like for the financial strength to be greater than or equal to a B+. Now that's an average condition for the value line financial strength rating. B+ is basically a 50 or an average condition. So we want average or better. And you can see that all of these fit that mold on the basis of the screen. And I said, thinking back to the Select Comfort, the mattress company story, I would like to know the companies that have high return potential with relatively little debts. I said long-term debt to total capital should be less than 20%. And we've actually only got one or two in here that are very high at all. The first one is the one that Susan wants to talk about. Zhongpin, the Hogs ticker symbol, does have a little bit of debt, but that's still relatively small on a comparative basis. But there's a whole lot of companies in here, and including kind of intriguingly, second in line here is Strayer. Strayer has no debt. They still have a good financial strength, and even with a recharacterized expectation for the future down, I think our projected returns are somewhere in the 20% range versus their 33 here. Kind of an interesting story. You see Intel down here, relatively small debt at Intel, A++ company with a projected return that is far above market conditions. And there's some others here. Aeropostale, company that kind of gives us all heartburn, but no debt, A financial strength, and some. I find it interesting that these educational companies are kind of coming into the fold here because they've really been hammered pretty extensively. And you can see Apple is near the top of this list too. Apple's not that attractive to this particular club because of the relative size of the Apple position right now. So I just kind of kicked this out. It's something I kind of want to play with as a proving ground for watching for those type of opportunities. Because I don't know about you, but anytime I can fish in an area where I might get a 65 or 100% return over a couple of years, possibly, conceivably, it's an area that I want to pay some attention to, and again, have kind of a different expectation level, and you have to treat them differently. Some of these are going to be a little bit less core. Treat them as a not so much a core opportunity, but could be some fascinating stuff.